If you're seeing silver at $75 right now, don't touch a thing. Look at me. Breathe. I know exactly what you're feeling, that hollow pit in your stomach, that voice saying, "It's over. I was wrong." But listen to this very carefully. If you sell now, you are falling into a trap designed to steal your position. Because while they're showing you $75 in the U.S., in China, they're paying nearly 90. What's happening this week isn't a crash. It's a mathematical ambush exactly 72 hours before the market changes forever. While you are staring at that red candle, the decision makers have left the room. They've handed the keys to algorithms designed to hunt your fear. We are in Ghost Week, a low-volume vacuum where the price isn't discovered, it's manufactured. During this time, trading volume on the COMEX, the main Western paper market for silver, just collapses. This year is no exception. We're seeing trading volumes that are a staggering 70% below the average. Now think about what that means. Judging the health of the silver market on Ghost Week trading is like trying to measure a tidal wave by looking at a ripple in a bathtub. The volume is so low that the price is almost meaningless. It doesn't reflect broad market sentiment. It reflects the actions of a tiny number of players in an empty room. And that is precisely why it's the perfect environment for a heist. In a market this thin, a single large sell order, or a series of them, can have an outsized impact. A manipulator doesn't need billions of dollars to move the price. They can use a fraction of that to start a cascade. They dump a large chunk of paper contracts on the market, pushing the price down a few dollars. This initial drop then triggers pre-programmed sell orders from algorithms. It triggers stop-loss orders from retail investors who are watching the price fall and starting to panic. But the most brutal mechanism is the margin call. As the paper price falls, anyone who bought silver futures on leverage gets a call from their broker demanding more cash to cover their position. If they can't pony up the cash immediately, their position is forcibly liquidated. They are sold out at the bottom, whether they want to be or not. And we have the data. Reports suggest that in this manufactured downturn, as many as 41,000 leveraged traders have been liquidated overnight. Think about that. Tens of thousands of investors, many of them small retail bulls who believed in the silver story, just got their positions wiped out. Not because the fundamentals changed, not because a massive new silver mine was discovered, but because a handful of players exploited a low-volume holiday window to weaponize the paper price and hunt for their stops and margin levels. This is the very definition of a shakeout. It's a manufactured event designed to punish the bulls and create an illusion of weakness. And hereas, the crucial context that the panic peddlers on TV will conveniently ignore. Even after this crash, silver is still up over 180% for the year 2025. It started the year near 29 an ounce. This isn't a bear market. It's a minor pullback in one of the most powerful bull markets we've ever seen. It's a consolidation, a test of conviction. The market is just taking a breath after a historic run, and the manipulators are using that breath to create a storm in a teacup, hoping you'll mistake it for a hurricane. They're trying to make you forget the big picture and focus on the scary, flashing red number on your screen. But that number is a ghost. Stop for a second. Ask yourself, if this were a real crash, why are the biggest players in the East still buying every ounce they can find? Do they know something about your paper losses that you don't? Let's look at the evidence in China. The West is trading promises. The East is trading reality. If you want to know why your screen says $75 but your dealer says out of stock, you need to look at the Shanghai Gold Exchange. The real story, the one that truly matters, is unfolding in the East. To find the true price of silver, you don't look at a thinly traded futures contract on the COMEX. You look at where actual physical metal is being bought and sold in massive quantities. And right now, that place is Shanghai. On the Shanghai Gold Exchange, SGE, they don't primarily trade in paper promises. They trade in physical metal for immediate delivery. This is where the world's largest industrial consumers come to get the silver they desperately need to keep their factories running, and the price they were reportedly paying on December 29th wasn't in the low 70s. It was as high as $89 per ounce. Let's be crystal clear. This is a premium of over $14 an ounce compared to the Western paper price. This isn't a few cents for shipping. This is a fundamental structural dislocation between the paper market and the physical market. It's the smoking gun that proves the Western price is a lie. So why is China paying so much? The answer is simple. They have no choice. China is the world's manufacturing hub and the epicenter of global industrial silver demand. More than half of all silver consumed globally is for industrial use. And China is the dominant player in nearly every one of those sectors. Think about the green energy transition. The solar panels being installed at a record pace are a primary driver of silver demand. The International Energy Agency projects that by the end of this decade, the solar and EV sectors alone could consume half of the entire global silver output. For these technologies, silver isn't optional. It's the most electrically conductive metal on Earth, and it has no viable substitutes for its most critical applications. You can't build a high-efficiency solar panel without silver. Then there's the tech revolution. AI data centers, 5G networks, electric vehicles, and countless consumer electronics all depend on silver. Elon Musk himself recently highlighted this, warning that silver is absolutely essential for many industrial processes. He's right. So when Chinese manufacturers see the global supply of silver shrinking, when they see inventories in Shanghai's vaults plummeting to the lowest levels in a decade, they don't panic sell. They panic buy. They get that their entire production line depends on securing this metal. To them, the price isn't a speculative bet. It's a cost of doing business. They will pay whatever it takes to get their hands on the physical ounces. This voracious demand is what's showing up in the SGE price. It's created a condition traders call backwardation, where the price for immediate physical delivery is much higher than the price for future delivery. This is a textbook sign of an acute physical shortage. The market is screaming that it wants metal now, not a paper promise for metal later. That huge premium is the market's way of saying, we don't believe your COMEX price. We need the real thing, and we will pay the real price for it. And it isn't just a few wealthy investors. We're seeing a retail frenzy in China as well, with funds like the UBS SDIC Silver Fund trading at enormous premiums as average people try to get exposure. From the factory floor to the individual citizen, the message from China is unified and deafening. We want physical silver, and we will outbid everyone to get it. That $89 price isn't an anomaly. It's the future. It's the signal of true price discovery. Now, any seasoned market observer would ask a logical question. If silver is in the low 70s in New York and supposedly $89 in Shanghai, why aren't traders performing arbitrage? Why aren't they buying thousands of cheap COMEX contracts, taking delivery of the physical metal, and shipping it to Shanghai for a risk-free profit of over $14 an ounce? That's how markets are supposed to work. Arbitrage is the glue that holds global prices together. The fact that this arbitrage is not happening, or at least not at a scale that can close this massive gap, is perhaps the most bullish and most terrifying signal in the entire market. The glue is no longer working. The market is broken. And the reason it's broken can be summarized in 3 words: the Great Wall of Silver. There are significant reports that China is building a strategic fortress around its domestic silver supply. The final bricks are allegedly being laid right now. Word on the street is that on January 1st, 2026, just days away, China is implementing a strict new set of export licensing rules for silver. From that day forward, any company wishing to export silver out of China would need a special government license. And the reported conditions for getting one are incredibly stringent. A company must have a huge annual production capacity and possess massive verified credit lines. These rules would effectively block hundreds of smaller firms that have traditionally been part of the global supply chain. Only large state-approved giants would be able to move metal out of the country, and only with the government's explicit permission. Think about the implications. China refines and controls a huge portion of the world's tradable silver supply. By implementing these export controls, Beijing would effectively be turning its entire country into a Hotel California for silver. The metal can check in, but it can't check out. This is a deliberate strategic move, the same playbook they've used with other critical resources. They're weaponizing their control over a strategic commodity. They understand that the future of technology, green energy, and military superiority depends on an uninterrupted supply of physical silver. And they're making sure they have it, even if the rest of the world doesn't. This Great Wall is why the arbitrage is broken. A trader might be able to buy silver in the West and ship it to China to capture that premium, but they can't be sure they'll ever be able to get their capital or any other metal back out. It's a one-way street. The flow of silver is now exclusively from west to east, with no release valve. This is why the premium in Shanghai can exist and grow. The COMEX price can be smashed down in a low-volume raid, but it doesn't matter. It doesn't entice any physical silver to leave China's gravitational pull. It only encourages more metal to flow into China, where the real price is being paid. The manipulators are trying to hold back the tide with a paper dam, while the physical ocean of Chinese demand is pulling every last ounce of real metal eastward. That price discrepancy is the sound of the dam cracking. Think about this. What happens to your wealth the moment that Great Wall of Silver fully closes on January 1st? Are you prepared to be locked out of the real market forever? Because the math says we are 72 hours away from the point of no return. The Ghost Week trap and the broken arbitrage with China aren't happening in a vacuum. They are symptoms of a much larger reality. The world is running out of available silver. The paper price crash is a desperate last-ditch attempt to hide a catastrophic physical supply squeeze that's been building for years. Look at the evidence. For 5 consecutive years, the world has been in a structural silver deficit. That means every single year, demand has outstripped the total supply from mining and recycling. In 2025 alone, the deficit is estimated to be over 230 million ounces. To put that in perspective, that's more than the entire annual production of Mexico, the world's largest silver mining nation. We are using more silver than we are producing year after year. So where has this extra silver been coming from? It's been coming from the warehouses, the above-ground inventories, the vaults in London, New York, and Shanghai that act as the world's buffer stock. But that buffer is now gone. Consider the COMEX, the site of this week's paper raid. According to some reports, the amount of silver in their registered category, the silver actually available for delivery, has plummeted by a shocking 70% since 2020. The situation in London is just as dire, with vaults there losing around 40% of their holdings. Some analysts estimate that, at the current rate of consumption, certain regions have barely 30 to 45 days of accessible silver reserves left. We are running on fumes. This depletion leads to one of the most frightening statistics in finance, the paper-to-physical leverage ratio. On the COMEX, some analysts have calculated this ratio has reached an astronomical 300 to 1. That would mean for every 300 ounces of silver owned on paper, there's only one single ounce of actual physical silver. It's a gigantic game of musical chairs with 300 players and only one chair. The system only works as long as nobody asks for the physical metal. But what happens when they do? What happens when even a tiny fraction of investors decide they want to convert their paper promise into a real asset? The system breaks. It's not a possibility. It's a mathematical certainty. A delivery failure on the COMEX is no longer a fringe theory. It is a clear and present danger. And don't think for a second this tightness is just a problem in China. Just try to go out and buy a U.S. Silver Eagle coin. You will not pay the spot price. Dealers are reporting premiums of 25% or more. That means you could be paying a price approaching $94 for a 1-ounce coin. That premium is the market telling you that physical silver is immensely more valuable than the spot price. This is the backdrop for the Ghost Week trap. The manipulators see the inventories draining. They see the deficits widening. They know the game is almost over. This price smash isn't an act of strength. It's an act of sheer desperation. They are trying to trigger a panic and convince you to sell your real, physical metal back into the system. They need it to deliver to the industrial giants who are now demanding the real thing. So let's bring this all together. What does this mean for you, the individual investor? You have to understand that you're not just watching a market event. You're the target of a psychological war. The price drop during Ghost Week is a weapon aimed directly at your conviction. It's designed to make you feel fear, to make you doubt your research, and to question the fundamentals. They want you to look at your statement, see the red number, and think, I've made a terrible mistake. They are counting on that emotional gut-level reaction. Because if they can scare you into selling, you'll be doing exactly what they need. You'll be selling them your irreplaceable asset at a fraudulent, manipulated paper price. You will be handing over your chair in the game of musical chairs just as the music is about to stop. The goal of this operation is simple: to facilitate one of the greatest wealth transfers in modern history. The institutions orchestrating this takedown are the same ones desperate to get their hands on physical metal. They need it to cover their massive short positions and to supply their industrial clients. They know when this paper game finally implodes, physical metal will be the only thing left with real value. They're trying to trick you into selling your real silver for a price in the low 70s, while they know the real price is closer to $80 and it's headed far, far higher. This moment is a test of your knowledge and your resolve. Do you believe the flickering mirage of a paper price from an empty trading room? Or do you believe the undeniable reality of a physical market in a historic supply squeeze? Do you listen to the talking heads on TV who've been wrong about silver for a decade? Or do you listen to the price signals coming from the largest industrial consumer on the planet? Selling now isn't an exit strategy. It's a surrender. You are giving the institutions exactly what they need to survive their own bankruptcy. Every ounce you drop at $75 is an ounce they don't have to buy at $89. This isn't a market fluctuation. It's a wealth transfer from the panicked to the informed. The $75 price is a ghost. The $89 price is the reality. In 72 hours, the mirage ends. You now know the game, and you know the stakes. The question isn't what the market will do. It's, do you have the courage to hold the line? Decisiveness is the only currency that matters now. I'll see you on the other side.